Hi, this is Jeffrey Kerr at Kerr Financial Group, and today is August 25, 2023, coming to the end of summer. I know some of the people I talked to down in Florida and the southeastern part of the United States have been real hot, so they're looking forward to some cooler weather. But here in the Northeast, we need to enjoy what's left. Today I wanted to talk about a couple of changes that have happened in the markets, and get into, I'm going to touch upon some Greek lettering as it relates to option trading and that whole influence, which has been greater this year. So, first of all, let me just as a high level, the markets are down in August, which is I think kind of surprising. So the Dow is down 4.1% in August, S&P down 4.6, Nasdaq down 6.1%. Again, it's only in 3 weeks. Now, to be sure, the year-to-date numbers are still pretty good. Dow's only up about 3%, but the S&P is up 14% year-to-date, even after this decline, and the Nasdaq 28.6%. Now, as I've talked to many of you about, a lot of this is driven by 7 to 10 stocks. If you go through the S&P 500 as of earlier this week, 10, 10 stocks, the 10 biggest stocks of the S&P 500 are up 47%, which drives, that 14% overall for the total index. You take out the 10 stocks, you have 490 stocks left. They're only up about 4% year to date. So again, the point of that is it's been driven by, a small part of the index, and they've been very strong, but they've also, there's not been wide leadership in the stock market. The other thing that I think is interesting is that interest rates have moved back up. So the 10-year Treasury bond, the yield on that back in April, May was 3.4%. It recently got to 4.3%. On a 30-year, those numbers back in April, May, 3.7, recently up to 4.3. So interest rates moved up, which is good if you're, getting a rate on savings or CDs or whatever. That's been welcome. But if you're, borrowing money and paying interest, that is, a big jump, and has been, I think, is going to be a headwind to the economy. So the other part I think the reasons for that are, the inflation looks to be, even though it's come down year over year significantly, looks like it may be bottoming and re-accelerating with oil being up and some food prices and housing and like that. So interest rates are adjusting higher, which I think again is going to be a pretty big obstacle economically. But I think also the other thing that I want to speak about is that the option trading, the 0 days to expiration option trading, which I've touched upon with some clients, it's kind of a complicated situation, but the point of it is the regime of the dealer's positioning has changed, and the change has been from positive, what it was for most of the 2023, to more recently negative. And what to try to touch upon this, there's the delta, a measurement that's called delta, which measures the change of the index versus the option. So if the S&P index goes up 1 point, the delta will give you how much the option changes. And then there's the gamma, which is the rate of change of the delta. So I've been trying to spend a lot of time understanding this a little bit better. It is pretty complicated, and if you don't trade options, it's may not be that important to you. But I think the importance and the significance here is that the institutions are doing a lot of trading in these short-dated options. They find it cheaper than buying futures, so it gains them the positioning either long or short that they can take advantage of it. I think they can take advantage of it in the short term and grind out some performance. I mean, again, the institution may have a bearish opinion, but they're going to be trying to make some money if they can, either direction in the short term, a day, a week, a month, whatever. So these option trading, which has become more and more popular. I think yesterday I saw the statistic yesterday, 54% of option trading were in short-term S&P options. It's a huge amount. It's really a significant part of the market and has a significant influence through the dealers. So the dealers sell the institutions the options, and then they hedge that positioning. Their dealer doesn't want to take a position in the market. All they want to do is the order flow. So whatever they do for their client who's an institution, they're going to do the opposite and to hedge off that exposure. And so again, the point is that throughout the whole first half of the year, the dealers had positive gamma, which was essentially a support to the market. They come in and would buy either futures or stocks to offset their positioning with their client. That is now flipped to negative gamma, which is a bigger risk. Now, can it flip back to positive? Yes, it can. But I think it's something that's really not considered. And from my reading, there is some risk here of the market hitting an air pocket, and that this negative gamma could accelerate a move to the downside. So just wanted to make you aware of that. If there's any questions, or if I'm still trying to learn. So if somebody out there has, some knowledge and help me understand it, I'm all ears. Any questions, comments, or whatever, please give me a call or email or text. And thank you for listening. Goodbye.